Hello and welcome to today's Your Daily Five. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and I'm happy to join you on this Monday, April 11th. Got a few interesting charts to show you today. Before we get started, though, I want to introduce you to earningsbeats.com if you're not familiar with us. If you go over to earningsbeats.com, get to our homepage and scroll down, I do publish a free Earnings Beats Digest newsletter 3 times a week, Mondays, Wednesdays, Fridays. It's a very quick read, usually just a couple paragraphs and a chart. So if you want to come over, learn a little bit more about how I look at the market, the way I use technical analysis. I also use fundamental analysis. I use seasonality, everything, historical perspective as well. But if you sign up with your name, email address, hit that subscribe button, I'll make sure we get these charts out to you. Also, by being an Earnings Beats Digest free subscriber, you're also invited to any free events that we do, and we happen to have one coming up this evening. It's going to be our sneak preview of our model ETF portfolio. In the last quarter, our model ETF portfolio beat the S&P 500 by 2 percentage points. We deliberately set up our portfolio. It was designed really to do well, or at least we expected it to do well in a volatile, inflationary type environment. And we'll probably be doing the same thing next week when we actually replace the stocks or the ETFs with new ETFs. So anyway, if you want to be included in that event later today, make sure you sign up here. Name and email address, hit that subscribe button. It's a free newsletter, no credit card required. You can unsubscribe at any time, and we'll make sure we get room instructions out to you this afternoon so you can join me later this afternoon. All right, 5 charts today. First one I want to deal with is inflation at the consumer level, core. At StockCharts, you can actually access the CPI data by simply typing in $CCPI. That'll get you the core consumer price index. And the way I've set this chart up, I've put it on a monthly chart. CPI only comes out once a month. So if you do it on a monthly chart, it kind of gets rid of all the noise. And you can look at a long-term chart. This is a 50-year monthly chart showing all of the CPI data monthly. And then down here at the bottom, I've done a 12-period rate of change. And since it's a monthly chart, this is a 12-month rate of change. So it's giving us the annual core inflation rate. Now, if you look back over the last year to 15 months, you'll see that we've had this huge spike in the inflation rate. That's been, what everyone's been talking about. That's why some of the growth stocks have been hit the way that they've been hit. It's not done yet going higher, though. The core inflation rate is about to go a little bit higher. Right now, we are at last month, we had an annual rate of 6.25%. The March number that's going to come out on Tuesday morning, April 12th at 8:30 a.m. Eastern, I expect it to be maybe 0.6%. I know other Wall Street analysts are looking for about 0.5%. But the number it's going to replace is the March 2021 reading, which was only 0.3%. So anything above 0.3%, and we're going to see that annual rate rise. Now, the interesting part about this, and this was information that I included in a Chart Watchers article over the weekend. Please do not ignore these 3 warning signs. And by the way, before I even go on, you can scroll down to the bottom of my article and you can put your email address in and subscribe. You can do this with any of the blog articles over at StockCharts, and there's no charge. All it does is just automatically sends to this email address that you input any articles that I write. So if you subscribe to my blog, as soon as I publish my article, it goes to your inbox, which I think is a pretty cool feature. And you can do that with any of your favorite authors at StockCharts. Anyhow, the next 3 months readings that we get in 2022, the April, May, and June 2022 readings are going to replace the 3 highest readings that we've had in the last year. So if inflation continues just to be around this 0.5 to 0.6% range, you can see the annual rate is going to start to drop. And I think that's really important because when we peak historically in inflation, that's when we begin to see money rotate back into growth stocks. So it's going to be really important, not just tomorrow's reading, but the next 3 as we move throughout spring and into early summer months, we could and probably will begin to see inflation drop. Just keep that in mind as we move forward. All right, another part of this article I wrote, I want to show you this rotation, this relative rotation graph. This is the RRG that just shows you the defensive sectors, which are in the leading quadrant. This is a weekly RRG. And down here's the tail length is 12 weeks. So it just plots each one of these sectors relative to the S&P 500 and just shows you where they are in their cycle. So all of the defensive groups are basically right up here in the leading. And meanwhile, the three most important aggressive groups, in my opinion, are technology, consumer discretionary, and communication services. All three are in the lagging. This is not the kind of environment where the stock market goes higher. We have to see this change. It hasn't changed yet, and that's one of the reasons why I think we need to remain very cautious. All right, it's not all bad news, though. I wrote another article that talked about, a red hot group that was threatening a breakout, and went on to talk about this, the defensive groups versus the aggressive groups. And you can see healthcare, consumer staples, utilities, real estate led the action last week to the upside. Meanwhile, all the aggressive groups were down. And I pointed out a group. This is the drug retail group. And if you look at it coming across here, it looks like a bottoming head and shoulder formation to me. Left shoulder, neckline, head, right side of the neckline, right shoulder. And then it looks like we're just making this breakout last week. So this is a really nice symmetrical bottoming head and shoulder formation. And we're just getting the breakout. And if you look at today and just update it today, you can see that we are up slightly today, another 0.4% to start this week. So this is a group that is benefiting from the rotation into consumer staples. So it's not all bad news. It's not like there's nothing that's going higher. But if you want to be on the long side in the market right now, it certainly pays to be more on the defensive side. And I think that's what this chart illustrates. Now, I mentioned that later today, I'm going to be doing an event talking about a model portfolio and how we construct it, and talk a little bit about maybe some of the areas of the market that we may want to include in our model ETF portfolio. We switch out our portfolios every 90 days. So what we're looking to do is to kind of forecast what we think the stock market's going to do over the next few months, what areas are going to be strong, and then we try to structure an ETF portfolio to benefit from that. So I wanted to point out this chart on global X SuperDividend US ETF. This is obviously it's going higher. Stock market's been going down. So you can clearly see that on a relative basis, this has been a very, very strong performer. The next panel I'll show you here is this ETF, the DIV, relative to the S&P 500. Again, moving higher. I think it looks, really strong, not too far from a relative breakout. Up here, I list the top 10 holdings. And when you look at these, no stock in this ETF represents more than 2.5% of the ETF. So it's a widely diversified ETF. And what I talk about when you put an ETF portfolio together, I always say you need to know what you own, because it's easy just to see a ticker going higher and then just buy it, but you have no idea what it owns unless you do some research. And that's what we try to do for our members at Earnings Beats, is provide not only the strong ETFs, but also to provide the holdings, the sector allocations, and so forth. I want you to take a look at the reason why DIV is performing so well right now. 18.46% of it is in energy. Energy is outperforming the S&P 500. This isn't rocket science. Next, utilities. Over 17% is in the utility group. Of course, one of the defensive areas. Look at utilities breaking to new highs versus the S&P. 15.3% is in consumer staples. So these three groups alone are more than 50% of the ETF. So it's widely diversified, but it's also somewhat concentrated in areas that should do well if the market is not performing well. And then on the flip side, technology, which is the highest concentration on the S&P 500, only 2% of this ETF is in technology. Look at technology relative to the S&P 500. It is now at about a 10-month relative low. You don't want a lot of technology right now. And so that's one of the reasons why this ETF is doing so well. Finally, the XLY versus the S&P 500, you can see only 8% of this ETF is invested in consumer discretionary, and consumer discretionary also downtrending. So you need to see what's going on with the market. You need to see what areas of the market's working, and then you need to understand these ETFs and why they're performing the way they are. And then you can make a more knowledgeable decision, more informed decision on what you'd want to do in terms of putting these portfolios together. The last chart I have for you today is a real simple one. Semiconductors. I think it's one of the most influential areas of the stock market. And the last 9 days, this area of the market's down more than 20%, or roughly 20%. 9 days, down almost 20%. And it is threatening a breakdown below what I consider to be a very significant support area. If you look back over the last 10 months, we have had multiple bottoms on the semiconductors between 7,000 and 7,200. We are now down 73 and change. We were just at 8,800 2 weeks ago. So we are rapidly coming back down and about to challenge this area. Look at the relative strength of semiconductors, or more appropriately, the relative weakness. This whole group has been under pressure now for about 4 or 5 months. It's continuing, and it's actually even accelerating to the downside. So you got to be careful on the semiconductors. And I think as long as semiconductors, which is one of the more influential, one of the more aggressive industry groups, until this group kind of rights the ship and starts to begin to repair its chart, I think the market overall is going to have a very, very difficult time in the days, weeks, and maybe even months ahead. So we want to be careful. Again, it was a pleasure joining you today on your Daily 5. Please remember to go to earningsbeats.com, sign up for this free EB Digest newsletter. I'd love to have you come in. I think you'll learn a lot just this afternoon from the event that we're going to have at 4:30 p.m. Eastern. Everybody have a great day. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.